US government's official gold reserves are valued at $42.22 per ounce. Now, if they were, it's not just a question of revaluing it, although they've gone through this trick of revaluing gold several times over the last 100 years. The trick here, which is what they need to do, is to sell that gold to the Federal Reserve. And this is something which has been done before. It's not like I'm inventing something new. They sell the gold to the Federal Reserve for the market value. My contention is they should stop at a much higher number so they can actually reduce the debt by a meaningful amount. Now, it doesn't have to be the entirety of the debt. That would be an impossible gold price. But what they could do is, say, set a figure of somewhere way above today's price. I mean, $15,000 for an ounce of gold would not be an unreasonable price.
The United States is sitting on a ticking financial time bomb, $39 trillion in national debt, a Federal Reserve caught between stubborn inflation and rising interest costs, and official gold reserves still valued at a relic price of just $42.20 per ounce. Meanwhile, global confidence in fiat currencies is quietly eroding. Central banks are quietly stockpiling gold at record levels, and the de-dollarization trend is gathering real momentum. The question is no longer whether something breaks, it's when and how. Clive Thompson, a seasoned precious metals analyst and longtime commentator on monetary policy and macro finance, explains that the real story unfolding today is not a resilient economy, but a system under quiet strain, collapsing real interest rates, unsustainable debt dynamics, and a government that may be forced to use its gold reserves in ways not seen since 1934, revaluing them dramatically and using the proceeds to buy breathing room from an otherwise inevitable fiscal reckoning. Now, we present the clips from Clive Thompson's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
US government's official gold reserves are valued at $42.22 per ounce. Now, if they were, it's not just a question of revaluing it, although they've gone through this trick of revaluing gold several times over the last 100 years. The trick here, which is what they need to do, is to sell that gold to the Federal Reserve. And this is something which has been done before. It's not like I'm inventing something new. They sell the gold to the Federal Reserve for the market value. That means they get in today's market value. And I'm saying today's market value because I'm going to come back to that in a minute, because it could be a lot higher than today's market value. So the Federal Reserve then buys the gold and pays the cash, pays what a couple of $1 trillion, over $1 trillion to the Treasury. They've got that, and they can now use that money to not to pay off debt or to spend or whatever they want. It doesn't pay off all the debt; it pays off a little bit of the debt at the market price. But the next trick that they'll do is do what they did in 1934 in the United States, which is to buy back the gold from the Federal Reserve, but issue in exchange, not treasury notes or treasury bills, they issue in exchange what's called gold notes. That's what they did before, and that's what they could do again. The beauty of gold notes is that for the Federal Reserve, they count as an asset, but as far as the Treasury is concerned, they have no redemption date. They're perpetual, and they have no interest rate. They don't have to pay interest on it. So they basically have given away a piece of paper which is worthless as far as the Treasury is concerned, but it's worth something to the Federal Reserve because it's an asset as far as the Federal Reserve is concerned, and it's worthless to the Treasury because they never have to repay it. They don't have to pay any interest on it, and they've got the gold back. So they keep the gold, but now they've got a whole bunch of money have come in from the initial sale to the Federal Reserve, which they can use. But why stop at 5,000? My contention is they should stop at a much higher number so they can actually reduce the debt by a meaningful amount. Now, it doesn't have to be the entirety of the debt. That would be an impossible gold price. But what they could do is, say, set a figure of somewhere way above today's price. I mean, $15,000 for an ounce of gold would not be an unreasonable price. We don't know if that would be what they could set, but certainly a higher figure than we have today of $5,000 or $4,000. But let's say they set it at $15,000. That would allow them to receive in several $1 trillion which could then be used to, one, retire a little bit of the debt. Don't forget the debt is over $30 trillion now. It's $39 trillion, something like that. So they could retire a little bit of the debt, and they wouldn't need to borrow any money for another year and a half, which would actually make the government's finances look much sounder, because the yield on, when they do that, because they're no longer needing to borrow, the demand for the treasuries is still going to be there. So the yield on treasuries is going to fall dramatically, and it's going to be a lot easier for a few years to fund government debt by borrowing money, because they won't have to pay the very high rates because the supply of treasuries will have dropped. It's certainly one of the reasons which is blamed for the fall in the gold price. But I think there's something different. A lot of people have seen a lot of people were buying into gold as it went into its peak at 5,500, and they are chasers. Those type of people are chasers of whatever's moving. So they've been coming out of gold and going into AI stocks. And we've been seeing some of these semiconductor stocks and AI stocks and data center stocks. Sometimes some of them rise 20% in a day. And it's when you've missed it, it's very frustrating. And people say, I've got to do something. Well, gold's not doing anything, so I'll jump into what I hope will be the next AI stock. So there's been a lot of movement with people chasing the AI bubble. I'm going to say bubble because I think it probably is a bubble. Now, that looks like it might be deflating, but as it deflates, people are not going back into gold yet, but at some point it's going to happen. In the 50 years I've been I've been an owner of gold for more than 50 years because I got my first gold sovereign at the age of 14 from my granddad. But I don't recollect any time when gold has been reacting to wars. Now, I might have forgotten maybe it did and I've forgotten it, but people always think it's a geopolitical hedge because historically, and we're now going back to before 1971, and probably we're talking about the war years. So going back to the war years of 1939 to 45 and before that, gold was the thing you could put in your pocket as you fled across the border. So in a war environment, gold became much more attractive. But we now live in a world where there are so many alternatives that gold just doesn't react to war unless you happen to be in the war zone itself. And even then, you still have alternatives like digital dollars, for example. So I don't think gold is particularly affected by localized wars anymore. What it is going to be affected by is confidence in the currency. And confidence in the currencies of this world is starting to erode. And that's something which could go very suddenly and very rapidly. You don't know what will cause it to speed up, but it could happen that we have some sort of geopolitical event, some natural disaster, some internal insurrection or civil war. We don't know. We could have some event which could trigger a sudden panic in the world currencies and people start rushing for hard assets. And then it becomes very hard for the government to finance whatever it's trying to finance, which is basically bailing out the system, because interest rates will be spiraling out of control, that nobody wants to lend to the government, and then they have to restart the system in some way. And there's many ways to restart the system, but none of them are good for the holders of currency. None of them are good for the holders of bonds. We've still got ongoing central bank demand rising. We've seen that gold has reached the highest level in central bank reserves ever. Now, that's partly due to the price appreciation, but also in part due to the ongoing purchases by a variety of non-US aligned central banks who basically increasing their reserves. We have a world where de-dollarization continues to gather traction. Countries around the world are saying, we might be very friends with the United States, but you just don't know how things are going to work out. Let's just modify our reserves a little bit. And if we're going to increase something, we'll increase the gold a little bit more. Then we've got the inflationary factor. Now, of course, one could argue that inflation is temporary with the rise in the oil price. But at the end of the day, the consumer price index, excluding oil and food, is still rising fairly strongly in the United States. So we have an inflation rate which is rising and making the real interest rate less and less. We're virtually at zero now in terms of the real interest rate. That should be positive for gold, but it's actually not turning out to be so because people are focusing more on the nominal interest rate at the moment, where it's kind of expected that the Federal Reserve will increase interest rates once this year in December. That's the present thinking. That might change and has changed several times in the past few months. Last but not least, we've got completely unsustainable levels of government debt around the world. It's not proving to be any particular problem at the moment because they're rapidly rolling it over. The debt is increasing at a pace which is faster than GDP. The interest payments are increasing at a very fast pace, and we're going up as a percentage of the total tax take. That's rising very rapidly, and it's going to continue rising according to the Bureau of Labour Statistics. So we're in a world where something could easily go wrong with government debt, and we all know what happens when something does go wrong with government debt. You're going to be paid either in very devalued dollars, pounds, euros, or yen, or you're not going to be paid in anything which is valuable at all, because the real danger we run in this world is one of some sort of currency reset, as has happened so many times around the world in the past. That's an all-time record. I think it was something in the low 80s last year was the expectation of central bankers that they'd be buyers of gold. So 91% of those surveyed said that they would expect to increase their gold reserves in the current year. Now, it's not clear what those surveyed mean, because that's the World Gold Council doing it, but certainly the number's gone up.
The mechanics behind the gold revaluation argument are more concrete than most people realize. The U.S. government could sell its gold to the Federal Reserve at a dramatically higher price, perhaps $15,000 per ounce, receiving several $1 trillion in return. Rather than issuing treasury notes, the Fed would receive gold notes, perpetual instruments with no redemption date and no interest obligation. The Treasury then buys the gold back, keeping its reserves while flooding its coffers with fresh capital. The result? A meaningful chunk of debt retired, reduced borrowing needs for a year or more, falling Treasury yields, and a temporary but real improvement in the appearance of government finances. Beyond this gold revaluation thesis, the structural case for higher gold and silver prices remains compelling on multiple fronts. Real interest rates are hovering near zero. Central banks, 91% of those surveyed by the World Gold Council, say they intend to increase gold reserves. De-dollarization is pulling non-U.S. aligned nations toward hard assets, and confidence in global fiat currencies, once lost, can erode suddenly and without warning. Silver, too, faces a persistent supply deficit, with industrial demand from electronics outpacing what mines can produce, suggesting higher prices are likely in the long run. Now, let's get back to the interview.
I've always had more gold than silver. But silver has caught up a lot because of the price rise generally, and I'm not tweaking it at all. I know there are people who like to tweak the ratio between gold and silver. When silver's high, they sell silver to buy gold and vice versa. But I'm not making that any changes like that. What I would say about silver is it's got twin uses. It's an industrial metal. Now, the demand for silver from the solar industry, the solar panel industry, is going to fall because alternatives are being found. But the demand from the electronics industry in general continues to rise. So it's likely that in the current year, more silver will be demanded. I mean, that's the forecast of the Silver Institute. So last year, there was last few years, there's been a deficit in silver. In other words, mined silver has not been sufficient to meet industrial use. And the forecast is the deficit will be a little bit larger this year, despite the decline in solar panel usage. So to meet that deficit, the silver has to come from somewhere. And where it comes from is recycled silver. Basically, people turning in their bars, turning their coins or their candlesticks or wherever silver can be obtained to be recycled. And every ounce of silver potentially available for recycling, which could include my coins, has some sort of price tag on it. And that price tag moves around all the time depending on how people feel and what other things they could do with their money. So at the moment, the price tag is probably below the peak. But if we start to get the feeling we're back in a bull market, people will start to raise the price tag at which they're willing to sell silver, and it'll become harder to get silver, and that would accelerate the rise. But yes, the silver price probably to meet that deficit, the silver price probably in the long run has to be higher than it is today. If we see central bank buying, buying, and as we have done, the last month, April, was we had negative buying in January, February, March, where central banks were net sellers, but in April they've become net buyers. If that continues, that's obviously a positive signal anyway. But I think more importantly, we've got to be looking at things like the movements in and out of ETFs. So the amount of gold in ETFs has been falling recently, so that's not yet a positive sign. The other thing I think we just need to keep an eye on is what's the price is telling us about itself. There's a lot of people who follow moving averages, and I don't aspire to this, but if gold and silver start to move higher, it'd have to be a sustained movement to start breaking above the moving averages. But when it does start to break through the moving averages, the 50-day moving average, the 200-day moving average, and things like that, then it's going to be triggering for all the technical analysts a lot of signals that they should be going in, and that becomes self-fulfilling. So in a way, all I can say is it goes down until it stops going down. When it's going up, it goes up. So how long is a piece of string? At what point you say, yes, it's been going up for a month or 2 months, now's the time? There isn't an answer to that. It's more of a gut feel. But if you're like me, you don't actually care. You're a stacker at every level. You buy if you've got the money and you have some space in your asset allocation to get the silver level to what you want it to, or the gold level to what you want it to, you buy. But if you're already at the level you should be, you don't want to be overextending yourself in one asset class. Can I just say one final thing, which I think is an interesting phenomenon, which I haven't said before, and that is about the gold mining, I'm talking about silver mining companies' profits. I just finished a study of what happened when they reported their results last quarter. So every company reported its results on a different day, and I measured the performance of only the out of the top 30 silver mining companies, only the companies which have a price earnings ratio of below 25 or 26. So that was a database of 16. I measured the price 7 days before they announced their results and the price 7 days after they announced their results. The average gain was 11.49 from 7 days before to 7 days after. Now, for some companies, there would have been better days to buy and sell. That's certainly true. But out of the 16 companies which met that criteria of a P less than 25, only 3 went down in those 14 days, and 13 of them went up in those 14 days. So what we've got coming up are the June results, and the June results are going to be announced towards the end of July and early August. So if you want a bit of fun, and I'm only speculating here, and you think the same trick might be repeated, we do know factually that these companies are going to report higher profits and higher sales, more or less across the board because of the higher silver price at the moment than a year ago. We do know that they're going to report higher profits. We do know the share prices have collapsed since I did this exercise. They're very, very low now, a half price effectively. So if you think they're going to react to record results in July or August, look at the date when they're going to report their results and think about whether you want to buy ahead of the news.
What makes Clive Thompson's perspective particularly valuable is the breadth and depth he brings to these interconnected macro forces. This isn't simply a gold bug's pitch, it's a forensic analysis of how monetary history, fiscal reality, and market psychology collide at a moment of unusual fragility. The gold revaluation playbook has historical precedent. The U.S. did something very similar in 1934, and the conditions today, massive debt, low real rates, a trapped central bank, echo that era in unsettling ways. At the same time, the near-term price action in gold and silver is being distorted by momentum traders rotating into AI stocks, creating a temporary pullback that long-term stackers may view as an opportunity rather than a warning. Thompson's own approach reflects this. He doesn't try to time the market, but instead maintains disciplined allocation, buying when he has the capital and the room in his portfolio, not because of where the price is today, but because of where the fundamentals point tomorrow. For investors navigating this environment, the key signals to watch are ETF flows in gold, the direction of central bank net buying, real interest rate trends, and the upcoming quarterly results from silver mining companies, which Thompson's own research suggests tend to outperform in the 14-day window around earnings announcements. Gold and silver are not just relics of the past. In a world where governments may be forced to reset the monetary system, they could be the most important assets of the future. Share your thoughts about this interview in the comments section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.